Hey everyone, and welcome back for another deep dive with us.
Always a pleasure to be here.
Today we're looking at something that's probably on a lot of people's minds.
I would say so.
It's the chance of a recession in the U.S. in 2025.
Right.
And we're not just talking about, reading the usual economic tea leaves here.
No.
We asked 5 different AIs to give us their predictions.
Oh, wow.
ChatGPT,
Okay.
Grok, Gemini, Copilot, and Claude.
Interesting mix.
Now get this.
Okay.
Just based on financial data,
Uh-huh.
they're already predicting a recession probability between 25 and 35%.
Really? Just on the data alone?
Just on the data alone.
Yeah, it's pretty significant.
And then we added in a real curveball.
Oh, boy.
What if you add in the potential policies of a returning Trump presidency
Okay.
with Elon Musk in charge of government efficiency?
All right, so we're getting a little hypothetical here,
A little bit, yeah.
but that's how we do it.
You have to hear what the AIs came up with. It's fascinating to say the least.
I'm all ears.
Now don't forget to hit that like button, subscribe, and let us know your thoughts in the comments.
Yes, please do.
Now let's dive in.
Let's do it.
What's really intriguing is how each AI approached the problem differently.
Oh, absolutely.
It's not just, a simple algorithm spitting out a number.
Right.
They each have their own way of weighing, economic indicators.
Sure.
Like GDP growth, unemployment rates, inflation.
All the big ones?
The usual suspects.
Exactly.
Right, because it's not just about what they predicted, but how they got there.
That's the key.
That's what makes this a real deep dive.
I agree.
So were there any AIs that stood out as being particularly pessimistic or optimistic?
Okay.
Even before we introduced the Trump and Musk factor.
Oh, absolutely.
Right. Okay.
Grok, for instance, was already leaning towards a higher probability right off the bat.
Interesting.
And that's because it factored in things like market sentiment.
Okay.
Basically how fearful investors are feeling about the future. So Grok uses something called market sentiment analysis, which digs into all sorts of data to gauge the overall mood.
So it's reading the room, so to speak.
Exactly. It's reading the room.
Got it.
So even before we threw in any political curveballs, Grok was saying, hey, things might be a little shaky.
Interesting. So Grok is kind of like the glass half empty AI in this scenario?
You could say that, yeah.
But does any of the AIs give us more of a glass half full perspective initially?
Gemini actually started off a bit more optimistic,
Okay.
putting the probability a bit lower than the others.
Interesting.
But then when we introduced the potential for things like trade wars,
Uh-huh.
even Gemini started to get a little nervous.
It makes sense.
It really highlights how interconnected everything is, right?
Right.
One policy shift can have ripple effects across the entire economy.
Exactly. So we've got this baseline range of 25 to 35% chance of recession based on pure economics.
Right.
Now let's add some fuel to the fire. See what happens when we factor in the potential policies of a returning Trump presidency.
All right, let's get into it.
What were some of the big ticket items the AIs focused on?
Well, as you might expect, trade and tariffs were a huge area of focus.
Okay.
Trump has proposed some pretty substantial tariffs. 25% on goods from Mexico and Canada.
Wow.
A whopping 60% on Chinese imports.
That's a lot.
And then another 20% on pretty much everything else coming in from around the world.
Wow, that's a lot of tariffs.
It is.
I mean, I know Trump is known for his America First approach,
Right.
but those numbers are pretty eye-popping.
They are substantial for sure.
What did the AIs have to say about the potential consequences of all those tariffs?
Well, they definitely didn't see it as a positive.
No.
Several AIs, including ChatGPT, predicted that these tariffs would really fuel inflation.
Yeah.
I mean, think about it.
Yeah.
If it costs more to import goods,
Uh-huh.
those costs are going to get passed down to consumers, right?
Right. It's basic supply and demand.
Exactly.
So higher prices, potentially less access to goods?
Right.
Not exactly a recipe for economic stability.
Not really, no.
Did the AIs see those tariffs leading to anything else besides inflation?
They also predicted a reduction in international trade volume.
Okay.
If you're slapping huge tariffs on imports, other countries aren't going to be too happy, right?
Makes sense.
They might retaliate with their own tariffs, and suddenly you've got a trade war brewing.
Right.
And that can really disrupt global trade flows,
Sure.
which can hurt businesses and economies around the world, including the U.S.
It's like a domino effect.
Exactly.
One tariff leads to another. And before you know it, the whole global trading system is in chaos.
Yeah, it can have a ripple effect.
And of course, that increased the likelihood of a recession, right?
For sure. The AIs were very clear that those tariffs, if implemented, would significantly increase the risk of a recession.
But tariffs weren't the only thing they were concerned about when it came to Trump's potential policies.
No, they weren't.
So what else was on the AI's radar?
Well,
What other potential policy changes from a Trump presidency were they factoring into their predictions?
tax reforms were another big one,
Okay.
but the AIs had a more mixed reaction to those.
Okay, interesting.
Some, like Grok, pointed out that while Trump's proposed tax cuts might give the economy a short-term boost,
Okay.
Put some more money in people's pockets,
Right.
they could also lead to much bigger federal deficits in the long run.
Right. It's the classic trade-off between short-term gain and long-term pain.
Exactly.
And I imagine those bigger deficits could lead to higher borrowing costs down the line,
Right.
which wouldn't be good for the economy either.
Not ideal, no.
It's like kicking the can down the road.
It is a bit like that, yeah.
And speaking of kicking the can down the road,
Oh.
the AI has also expressed some concern about Trump's potential approach to the Federal Reserve.
Oh, right, the Fed.
I remember hearing something about Trump wanting to have more control over the Fed. What exactly were the AIs worried about there?
Well, a couple of them, specifically Grok and ChatGPT,
Okay.
were concerned about the potential for Trump to try and set interest rates directly.
Whoa.
Yeah.
That sounds like a recipe for disaster.
It could be problematic.
I mean, isn't the whole point of the Fed to be independent from political influence?
That's the general idea, yes.
Right.
The AIs were concerned that if Trump were to start meddling with interest rates, it could create a lot of volatility and uncertainty in the market,
Sure.
and that could undermine confidence in the economy, which is never a good thing.
Right. It's like playing with fire.
It's a risky move.
So we've got tariffs, tax cuts, and potential Fed meddling.
Right.
All things that the AIs saw as potentially increasing the risk of a recession.
Yeah, they definitely raised some red flags.
Anything else on the Trump policy front that we should be aware of?
Immigration policies were another area of concern.
Okay.
ChatGPT in particular highlighted the potential for labor shortages if mass deportations were to occur. And that could have a ripple effect on businesses, leading to higher costs and potentially even more inflation.
Wow, so it's all connected.
It is.
It's like one big complex web of cause and effect.
That's a good way to put it.
And it seems like a lot of those potential effects aren't exactly positive from an economic standpoint.
No, not really.
The AIs were definitely painting a picture of heightened risk and uncertainty when it came to a potential Trump presidency and its impact on the economy.
Yeah, there's definitely a lot of potential for volatility there.
But remember, we haven't even brought Elon Musk into the mix yet.
Oh, that's right. We've got another big personality to consider.
That's right.
And a whole other set of potential policy changes.
We've got another big personality and a whole other set of potential policies to factor in.
It's going to get interesting.
So what happens when we add Elon Musk and his efficiency crusade to the equation?
Ooh, good question.
You'll have to stay tuned for part 2 of our deep dive to find out.
I can't wait. Welcome back to our deep dive,
Back into this wild world of AI economics.
where we're trying to, really understand what a 2025 recession might look like.
Yeah, I mean, it's the question on everyone's mind,
Right,
right?
it's a big one.
Are we heading for a recession?
Especially with all these factors we're talking about.
Exactly. And remember, we're not just looking at, cold, hard economic data.
Yeah,
We've added in the wild card of, potential policies from a returning Trump presidency
of course.
and Elon Musk leading the charge on government efficiency.
It's a lot to unpack.
It's a fascinating mix of variables.
Yeah.
And the AIs came up with some surprising predictions,
Oh, really?
especially when you look at how those recession probabilities
Okay.
actually fluctuate throughout the year.
Oh, that's interesting. So it's not
It's not static.
a static number.
Give us the breakdown.
All right. So each AI gave us a quarter-by-quarter prediction.
Okay,
And trust me, these numbers tell a much more interesting story.
I'm ready.
Let's start with Q1 of 2025.
Okay, first 3 months of the year.
Most of the AIs put the recession probability somewhere between 30 and 35% for those first 3 months.
Okay, so slightly lower than the overall yearly average we talked about earlier,
Yeah, just a little bit.
but still a 1 in 3 chance of a recession right out of the gate.
It's significant.
It's nothing to sneeze at.
No, it's not.
Why this slightly lower probability at the beginning of the year, though?
Well, it makes sense when you think about it.
Good.
New policies, even radical ones,
Yeah.
take time to really, filter down and impact the economy.
Right. They don't have an immediate effect.
Exactly. It takes time.
In that first quarter, we're still dealing with a lot of carryover from the previous year.
Okay, so we're still kind of coasting
A little bit, yeah.
on the previous year's momentum.
Right. So those initial predictions are more heavily influenced by, the pre-policy economic indicators we discussed earlier.
Okay, got it. So the initial shock hasn't quite hit the system yet.
Not yet, no.
But what happens as we move into the second quarter?
Oh, things start to get a little more interesting. Does that probability start to creep up as those Trump and Musk policies kick in?
But you bet it does. The AIs are pretty consistent in predicting a jump in probability,
Okay.
generally landing somewhere in the 35–40% range for Q2.
So things are getting a little dicey.
A little bit, yeah.
This is where those big policy shifts,
Right.
things like tariffs and spending cuts, really start to make their presence felt.
Yeah, that's when the rubber meets the road.
Yeah. I can't imagine tariffs and spending cuts are going to do wonders for consumer confidence.
No, probably not.
People are going to start feeling the pinch.
They're going to start to feel it, yeah.
Exactly. The AIs are anticipating some serious economic turbulence as those policies begin to bite.
It's not going to be a smooth ride.
And things get even more interesting, or maybe I should say nerve-wracking,
Oh, boy.
as we move into the second half of the year.
Okay, buckle up.
Just how high do those probabilities climb?
Well, hold on your hat because we're officially entering nail-biter territory.
Oh, I'm getting a little anxious over here.
Yeah. For Q3, the range jumps to roughly 40–50%.
Wow. We're getting up there.
Yeah, it's getting serious.
And by the time we hit the final quarter of 2025,
Right, the home stretch.
a couple of the AIs, specifically Claude and Grok,
Right?
are actually predicting probabilities above 50%.
Yikes.
That's a pretty stark shift.
Yeah, it's a big jump.
We're talking about a coin toss at that point, essentially.
Pretty much, yeah.
What's driving those higher probabilities in the later part of the year?
I mean, is it just the cumulative effect of all those policies we talked about? It's definitely a snowball effect.
Okay.
You know, those policy impacts inflation from tariffs, potential job losses from immigration policies. The ripple effects of those spending cuts,
Right.
they all start to compound over time.
So there's not just one thing. It's like
It's not just one thing.
the combination of all these factors
Yeah,
interacting and amplifying each other.
it's a recipe for trouble.
So it's like a perfect storm brewing, economically speaking.
It kind of is, yeah.
And to make matters worse, we're not even factoring in potential global economic turmoil, right?
Right.
I mean, Germany's having its own issues.
Oh, yeah.
China's economy is slowing down.
Absolutely.
That can't be helping things.
Oh, it's not helping.
Absolutely. Those global headwinds are definitely adding fuel to the fire.
They are.
Germany's struggling manufacturing sector, China's property crisis,
Yeah.
could easily spill over and drag down the U.S. economy as well.
It's definitely a possibility.
I mean, it's a globalized world.
It is.
We're all interconnected, whether we like it or not.
That's the reality.
Okay, so we've got a pretty clear picture
Right.
of how those recession probabilities evolve throughout the year.
They do paint a clear picture.
But let's dig a little deeper into the specific factors
Okay.
that are driving those predictions.
All right, let's get into the weeds.
We've talked about the big ones: tariffs,
Uh-huh.
spending cuts, global instability.
Right.
What are some of the more nuanced details that the AIs considered?
Well, one factor that really stood out
Okay.
was the potential impact on consumer spending,
Okay. Consumer spending, of course, being the engine
the engine of the economy.
that drives the economy.
And if people start to feel uncertain about the future,
Yeah.
they're going to tighten their belts.
Right.
And that can have a domino effect across the entire economy.
Exactly. It's all about confidence.
Confidence is key.
If people are worried about losing their jobs
Uh-huh.
or seeing their savings dwindle,
Right.
they're not going to be rushing out to buy new cars and flat screen TVs.
Not at all.
Did the AIs pick up on any specific signals that suggest consumer confidence could take a hit?
Definitely.
Okay.
For one, there's the potential for higher prices due to those tariffs we talked about.
Yeah.
Inflation is already a concern,
Right.
and those tariffs could easily make things worse.
Yeah. No one likes to see their grocery bill go up.
Nobody likes that.
And then, of course, there's the uncertainty surrounding job security.
Oh, yeah, a big one.
If those immigration policies lead to labor shortages,
Right.
some businesses might be forced to cut back or even lay off workers.
Unfortunately, that's a possibility.
And that's going to make people even more hesitant to spend money.
Definitely.
It becomes a vicious cycle.
It does.
Less spending leads to less economic activity, which can lead to more job losses and so on.
It's a downward spiral.
So consumer spending is a big piece of the puzzle,
It is.
but it's not the only piece, right?
No.
What else are the AIs looking at?
Another factor that came up repeatedly was the potential impact on business investment.
Okay, business investment.
Right.
Which is obviously crucial for growth.
Absolutely. Businesses make investment decisions based on their expectations for the future.
Right. So if they're not feeling confident,
Exactly. If they're feeling uncertain or pessimistic,
Yeah.
they're going to be less likely to invest in new projects, expand their operations, or hire new workers.
So that uncertainty that we keep talking about can really stifle economic growth.
It can really put the brakes on things.
It's like everyone's hitting the pause button waiting to see what happens next.
Pretty much, yeah. Everyone's in wait-and-see mode.
Exactly. And remember, the AIs are picking up on a lot of mixed signals.
There are a lot of conflicting factors.
On the one hand,
Right.
you've got some positive indicators like strong corporate earnings, a relatively healthy labor market.
Right.
But on the other hand,
Right.
you've got those policy uncertainties,
Yeah.
rising inflation, global economic headwinds.
It's a mixed bag.
It's a confusing picture,
It is.
and it's making businesses cautious.
Understandably so.
So we've got consumer spending,
Right.
business investment, two major pillars of the economy potentially wobbling.
Yeah, those are two big ones.
Are there any other nuanced factors
Let me think.
that the AIs are factoring into their predictions?
Another one that came up a few times was the potential impact on the housing market.
Okay, the housing market.
Yeah.
Another big one.
Now, higher interest rates are already putting pressure on the housing market,
Right.
making it more expensive for people to buy homes.
Uh-huh.
And if the economy slows down, we could see a decline in housing prices,
Right.
which could further erode consumer confidence and wealth.
Yeah, because for a lot of people, their home is their biggest asset.
Absolutely.
If housing prices start to fall, it can feel like the bottom is dropping out.
Yeah, it can be a big psychological blow.
Even if other parts of the economy are holding up, okay.
Right. It's a big part of people's sense of financial security.
Exactly. And that's what makes these AI predictions so fascinating.
They are fascinating.
They're not just looking at, one or two isolated factors.
I know.
They're considering the entire economic ecosystem.
Right. They're looking at the big picture.
How all these different pieces interact with each other.
It's like a giant puzzle.
It's like a giant complex puzzle.
And they're trying to put all the pieces together
Right.
to see what picture emerges.
And as we've seen, the picture they're painting is one of heightened risk and uncertainty.
There's definitely a sense of caution in their predictions.
Especially as we move into the latter half of 2025.
Yeah, the later we get, the more those probabilities seem to rise.
But even though those probabilities are going up,
Right.
it's important to remember that they're still just probabilities.
Right. That's a crucial point.
Nothing is set in stone.
Absolutely.
The future is never predetermined.
No, it's always in flux.
There are always unexpected events,
Right.
unforeseen consequences, and the ever-present wild card of human behavior.
You can't predict human behavior.
Those things can throw even the most sophisticated algorithms off course.
That's right.
So while these AI predictions give us valuable insights
They do.
and help us understand potential risks,
Right.
it's crucial to maintain a healthy dose of skepticism.
Don't panic.
Don't panic,
Yeah.
but don't bury your head in the sand either.
Exactly.
Don't ignore the warning signs, but don't let them paralyze you either.
It's all about finding that balance.
Okay, so we've got a pretty good grasp on the nuanced details behind those AI predictions
Okay.
and how those probabilities evolve throughout the year.
Right. It's a dynamic situation.
But before we move on to what all of this means for you, our listeners,
Okay.
I want to circle back to something you mentioned earlier,
What's that?
the global economic picture.
Oh, yeah. The international scene.
How are those international headwinds potentially impacting the U.S. economy?
Well, we've already touched on Germany and China,
Right.
but they're not the only ones facing challenges.
Right. The global economy is like
It's interconnected.
a giant interconnected web.
And weakness in one area can quickly spread to others.
Yeah. So it's like we're all in this together, right?
We are, whether we like it or not.
What are some of the specific ways that those global headwinds could impact the U.S.?
Okay, so let's get specific.
Are we talking about job losses, market instability, that sort of thing?
You hit the nail on the head.
Okay.
For one, it could hurt U.S. exports. If Germany and China are buying less,
Yeah.
that's going to impact American businesses that sell goods and services overseas.
Right. And that could lead to job losses
Exactly.
and slower economic growth here at home.
It's all connected.
And then there's the potential impact on financial markets.
Oh, right.
If investors start to get nervous about the global economy,
Yeah.
they might pull their money out of riskier assets, which could lead to market volatility and potentially even a financial crisis.
That's the worry.
So the global economic picture is definitely something to keep an eye on.
Definitely a factor to consider.
It sounds like those international headwinds could make a recession in the U.S. even more likely,
Yeah, they're not helping.
especially when you combine them with all the potential domestic policy changes we've been discussing.
It's a lot of potential for instability.
That's right. The U.S. economy isn't immune
Nope.
to what's happening in the rest of the world.
It's all connected.
We're all in this together,
We are.
for better or for worse.
That's the truth.
Okay, so it sounds like we've got a lot to think about.
We do.
But before we get too bogged down in all the doom and gloom,
Right.
let's shift gears and talk about what all of this means for you, our listeners.
Okay, let's get practical.
In part 3 of our deep dive,
All right.
we'll explore what you can do to prepare for a potential recession.
Okay. Some actionable advice.
How to make sense of all this information.
Right, because it's a lot to process.
And most importantly, how to stay informed
Uh-huh.
and navigate this uncertain economic landscape.
It's all about being prepared.
Stay tuned. Welcome back to the final part of our deep dive
To grand finale,
into the economic crystal ball.
where we try to make sense of the future.
We've explored the AI predictions, crunched the numbers,
Gazed into that crystal ball.
and gazed into a future that frankly looks a little turbulent.
It's definitely got some choppy waters ahead.
But now let's shift gears.
Okay.
Talk about what all of this means for you.
You got it, the listener.
Because at the end of the day, knowledge is power, right?
Yeah. Absolutely.
Understanding these potential economic shifts
Uh-huh.
can help you make informed decisions
That's the goal.
for your own financial well-being.
Protect yourself.
So let's start with the big question.
Okay, shoot.
How seriously should we take these AI predictions?
Right.
I mean, they're fascinating, sure.
They are intriguing.
But are we talking about a guaranteed economic meltdown?
That's the thing, isn't it?
It's easy to get swept up in the doom and gloom,
It is.
but it's important to remember
Uh-huh.
these are just predictions, not guarantees.
Right. It's not a done deal.
AI is a powerful tool,
It is.
but it's not a crystal ball.
No, it can't see the future perfectly.
Precisely these models are based on
Right. They take into account
historical data
Mhm.
and current trends,
the information they have.
but they can't predict the future
Nope.
with 100% certainty.
There's always that margin of error.
There are always those unexpected events.
Right.
You know, black swan moments, if you will.
The things you just can't anticipate.
That can throw even the most sophisticated algorithms off course.
Exactly. AI is not perfect.
Right, like who could have predicted a global pandemic a few years ago?
I mean, nobody saw that coming.
Or that Elon Musk would be in charge of government efficiency?
That's a curveball for sure.
Life is full of surprises.
It keeps us on our toes.
So while these AI predictions give us valuable insights,
They do.
help us understand potential risks,
Uh-huh.
it's crucial to maintain a healthy dose of skepticism.
Right. Don't just take it as gospel.
Don't panic.
Stay calm.
But don't bury your head in the sand either.
No. Be aware of what's going on.
Don't ignore the warning signs.
Uh-huh.
But don't let them paralyze you either.
It's about finding that balance.
Now let's talk about what you can do
Oh, hey, let's get practical.
to prepare for a potential recession,
Right.
even if it's not a guaranteed outcome.
Be prepared just in case.
What are some practical steps our listeners can take to weather the economic storm, so to speak?
Well, one of the most important things
Okay, give us a rundown.
is to review your personal finances.
Okay.
Take a close look at your budget,
Uh-huh.
your spending habits, your debt levels.
Make sure everything's in order.
Make sure you have a clear picture
Right.
of where your money is going,
Uh-huh.
and identify areas where you might be able to cut back if needed.
It's like getting your financial house in order, right?
Exactly.
Making sure the foundation is solid
Tell a foundation.
before the storm hits.
Exactly.
It's also a good idea to build up an emergency fund.
Oh, for sure.
Having that financial cushion can provide real peace of mind
It can really help you sleep at night.
and help you navigate unexpected expenses
Right.
or income disruptions.
Especially if the economy takes a downturn.
Absolutely. Aim for 3 to 6 months worth of living expenses if possible.
If you can swing it.
It might seem like a daunting goal,
I know it can seem like a lot.
but even small, consistent contributions can add up over time.
Every little bit helps.
This might sound obvious,
Okay.
but it's worth repeating.
All right, lay it on me.
Pay down high-interest debt.
Oh, yeah, that's a big one.
Credit card debt, for example, can quickly spiral out of control,
It can get away from you really fast
especially during times of economic uncertainty.
when things are already tight.
And if recession does hit, you want to be in the strongest financial position possible.
You want to be as prepared as you can be.
Absolutely. Now, another thing to consider is your career and job security.
Oh, right, your livelihood.
Recessions often lead to job losses.
That's unfortunately a common consequence.
So it's smart to be proactive and think about your options.
Don't wait until it's too late.
Right, because even if you're feeling secure in your job right now,
Yeah,
things can change quickly
it can.
in a volatile economic environment.
It's a dynamic situation.
Exactly. Take some time to assess your skills,
Okay.
your value to your employer,
Uh-huh.
the overall health of your industry.
Is your industry doing well?
If you're in a field that's particularly vulnerable to economic downturns,
Right.
it might be wise to start exploring other options.
Okay, so have a backup plan.
Or developing in-demand skills
Skills that are always in need.
that will make you more marketable,
Uh-huh.
regardless of what happens in the economy.
Can you're prepared no matter what?
So it's about being adaptable
Right.
and having a plan B just in case.
Exactly.
And networking is always crucial.
Oh, yeah. Building relationships is key.
Building strong relationships with people in your field
Mm-hmm.
can open doors to new opportunities,
It's all about who you know.
especially if you find yourself needing to make a career change.
Okay, so we've covered personal finances, emergency funds,
Debt management.
career planning.
What else should our listeners be thinking about
Hmm.
as we head into this potentially choppy economic period?
Well, staying informed is key.
Okay, so stay in the loop.
Keep up with economic news. Track key indicators.
Right. Know what to look for,
And pay attention to what experts are saying.
but be mindful of your sources, right?
Oh, yeah, absolutely.
There's a lot of misinformation and fear-mongering out there.
Especially during times of economic uncertainty.
It's easy to get caught up in the hype,
It is.
but it's important to filter out the noise
Focus on what's reliable.
and focus on reliable, fact-based information.
Stick to the facts.
Exactly. Stick to reputable news outlets, financial institutions, and economists with a proven track record.
The people who know what they're talking about.
And remember, it's not just about reacting to events as they unfold.
Right.
It's about being proactive, making informed decisions,
Be ahead of the game.
and staying ahead of the curve.
Exactly.
It's about taking control of your financial future,
Don't let the future control you.
rather than letting events control you.
Be the master of your own destiny.
Now, before we wrap up,
Okay.
I want to leave our listeners with a few final thoughts.
All right, some parting words of wisdom.
First, don't underestimate the power of community.
Oh, yeah. Community is so important.
Connect with friends, family, and neighbors.
Your support system.
Share resources, support each other,
We're all in this together.
and build a network of resilience.
Exactly. We can get through this together.
Absolutely, recessions can be tough,
It can be challenging.
but they can also bring people together.
It's a time to lean on each other.
It's a time to lean on each other and build stronger communities.
Exactly. Second, remember that recessions are a natural part of the economic cycle.
Right. They're not a sign of the apocalypse.
They're just a downturn.
They're not fun,
No, but they're not forever.
but they don't last forever.
The economy will recover.
And they often create opportunities for innovation growth and positive change.
That's right. Sometimes you have to break things down to build them back up better.
So stay positive, stay informed, and stay proactive.
You got this.
That's a great message to end on.
Thanks for having me.
Thanks for joining us on this deep
It
dive
is my pleasure.
into the potentially turbulent economic waters of 2025.
It's been a wild ride.
We hope you found it informative
And hopefully a little bit reassuring.
and, most importantly, empowering.
That's what we aim for.
Don't forget to like, subscribe, and tell us your thoughts in the comments below.
We love hearing from you.
We'd love to hear from you. Until next time, stay curious and keep learning.